Stop scrolling for a second. If you're about to buy a day trading course, if your cursor is hovering over checkout, if you've already watched the testimonials, if you can almost feel the relief of finally figuring it out, pause. Not because day trading is illegal, not because you're not smart enough, not because you don't deserve a breakthrough. Pause because there's one number that separates an investment from a story, and most sales pages quietly avoid it. Show me. The results after fees, after slippage, after taxes, across enough time that luck can't fake skill. If that number isn't there, clearly, verifiably, boringly documented, then whatever you're about to buy is not an investment. It's a narrative. And Benjamin Graham had a very simple way to classify narratives in the market: speculation. Now, I'm not here to dunk on you. I get it. The market has gotten louder. The feeds move faster than your brain. Everyone is posting screenshots of wins, 0 DTE options, prop firm payouts, Discord signals, AI trading bots, charts that look like secret code. And if you're a normal person with a normal job, it can feel like you're watching other people sprint while you're walking. So let's do something different. Something Graham would respect. Before you spend $1 on any day trading course, I'm going to give you a Graham-style pre-purchase test. 6 questions. And if the course fails, even 2 of them, you're not buying an edge. You're buying hope. And hope is not a margin of safety. Picture this. It's 11:47 p.m. You're in bed, phone glowing in your face. The house is quiet. You tell yourself you're just researching. But you've already watched 3 success stories and a highlight reel of someone turning $1,000 into $10,000 in a week. The sales page is doing what it's designed to do. It's making the future feel close. It's making certainty feel purchasable. And right before you click buy, ask yourself, what business are you actually entering? Because here's the uncomfortable truth. In a lot of the day trading education world, the product isn't trading. The product is you, your subscription, your renewal, your upgrade, your advanced mentorship, your recurring monthly fee for a chat room, your endless appetite for the next indicator. That doesn't automatically make it a scam, but it tells you something about incentives. And Graham cared obsessively about incentives. He cared about the difference between what looks good and what is good. So let's anchor ourselves in his definition. Graham's classic idea is simple. An investment operation is one that, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative. Notice what's missing: excitement. Notice what's missing: certainty. Notice what's missing: 3 easy steps. And here's the key connection most people miss. That definition doesn't just apply to stocks. It applies to anything you do with money, including buying a day trading course. So when someone tells you this is a proven system, Graham would ask, proven how? Under what conditions? At what cost? With what risks? Compared to what alternative? Because price and value are not the same thing. And in today's market, a lot of people confuse a good story with a good deal. Let me make this real with a person you probably recognize. Call him Mike. He's 42, Ohio, 2 kids, a decent job. He's done the right things most of his life. Contributes to a 401k, pays the mortgage, tries not to blow money. But then inflation hits, prices jump, and he starts doing math in his head. He realizes retirement isn't a finish line. It's a number, and that number feels far away. So when he sees someone online saying, I make $500 a day trading before lunch, it doesn't just sound like money. It sounds like time. It sounds like a way to catch up. Mike buys the course. He's disciplined for a week. He studies charts, learns setups, prints out rules, and then something dangerous happens. He wins early. That's when the hook sets. Because the market, Mr. Market, as Graham called him, doesn't just offer you prices. He offers you moods. He offers you emotional reinforcement. And nothing reinforces like early wins. They don't prove skill. They create belief. Then Mike takes a bigger position. Then he takes one trade off plan because it looks so obvious. Then he tries to make back a loss. Then he discovers the invisible bill no one put on the banner. Friction, spreads, slippage, commissions, platform fees, data fees, option bid ask spreads that chew up your edge before you even blink. The fact that your fill price is rarely the price in the screenshot, and taxes. In the US, most day trading profits are short term. That means they're generally taxed like ordinary income, not like long-term capital gains. Add state taxes in many places, and suddenly your monthly P&L isn't what you thought it was. Meanwhile, losses don't always offset neatly the way people imagine, especially if you're not operating with the right structure and records. So, Mike has a month where he feels like a genius, then a week where he gives it back, then a day where he loses more than he ever made in a day at work. Not because he's stupid, because the game he entered was built around thin margins, high turnover, and emotional pressure. And that's the point. The average investor doesn't get destroyed by ignorance. They get destroyed by the mismatch between what they think they're doing and what they're actually doing. They think they're investing, but they're speculating. Now let's do the pre-purchase test. And I want you to imagine you're holding that checkout page open while we do it, because this isn't theory. This is protection. Question 1. Do they show a verifiable track record after costs? Not a screenshot, not a cherry-picked month, not a highlight reel. A real record means a meaningful time period, a clear methodology, and results that include realistic trading costs, fees, slippage, spreads, and ideally, some form of third-party verification, or at least raw statements with enough detail that a serious person can audit the claims. If the sales page says results not typical, but the entire page is built on typical results, that's not education, that's persuasion. And here's the part that stings. If they truly had a durable edge that scaled, the highest paying use of their time would usually be compounding that edge quietly, not selling it to thousands of strangers who will compete away whatever advantage exists. Could there be exceptions? Sure. People teach for many reasons. But Graham didn't build a philosophy on exceptions. He built it on what's probable, what's repeatable, and what's safe. Question 2. Do they show the downside like adults? Where is the drawdown? Where are the losing streaks? Where are the months where it didn't work? Any strategy can look brilliant on a straight line chart. The real story is the valley. The real story is the maximum drawdown and what it takes psychologically and financially to survive it. A course that only shows winners is like a bridge engineer who only shows you pictures of sunny days and refuses to discuss hurricanes. Margin of safety means you plan for the storm, not for the brochure. Now, if you're already feeling a little uneasy, good. That's not fear. That's clarity. Graham wasn't anti-market. He was anti-self-deception. And here's where Mr. Market shows up in a different costume. In Graham's famous metaphor, Mr. Market is your business partner who shows up every day offering to buy or sell at emotional prices. Some days he's euphoric, some days he's depressed. Your job is not to copy his mood, it's to use his offers intelligently. But in the day trading course world, Mr. Market isn't just offering prices. He's offering identity. He's offering belonging. He's offering the feeling that you're one system away from escaping your job, your debt, your timeline. And that's why so many smart people get trapped, because the trap isn't intellectual, it's emotional. So let's keep going. Question 3. Can they explain the edge in one sentence without mysticism? If the strategy boils down to trust me, feel the tape, the market speaks, this indicator is secret, or our AI finds hidden patterns, then you're not buying analysis, you're buying authority. Real edge, if it exists, has to have a mechanism, something like we exploit a specific behavioral tendency under specific conditions with strict risk controls. Even then, you'd still need evidence, but at least you'd be dealing with reality. And pay attention to this. If their explanation requires constant screen time, fast execution, and emotional control under stress, then the strategy isn't just a strategy, it's a lifestyle. So you need to ask, is this compatible with your life? If you have a job, kids, sleep needs, stress limits, a marriage, a nervous system, is it rational to build your financial future on your ability to stay calm while your P&L swings every minute? Graham would call that speculative, not because it's immoral, but because safety of principle is not the first priority. Your temperament becomes the fragile link. Now, before we hit question 4, I want to pull the curtain back on the math the marketing rarely touches, because this alone will save you from expensive illusions. Day trading is a high turnover activity. High turnover means friction costs compound against you. Let's keep it simple. Imagine you take multiple trades a day. Even if you're trading commission-free, you still pay the spread. You still pay slippage. You still pay less favorable fills when volatility spikes. If you're trading options, the bid-ask spread can be brutal. If you're trading during fast moves, your entry becomes a suggestion. And here's the killer. A strategy with a tiny edge can be completely wiped out by tiny costs. If your average trade earns, say, a few cents of advantage, and your spread plus slippage eats a few cents, your edge is gone. Not sometimes, structurally. And that's before taxes. It's not that no one can do it. It's that the average person doesn't understand what they're signing up for. They're trying to pull profit out of noise at high speed with real money while paying invisible tolls on every trade. That's why Graham's world looks boring, because boring is where the math works. Now, question 4. Do they teach position sizing and survival, or just entries? This is where most trading education quietly collapses. Because entries are exciting. Entries sell. Risk management is not exciting. Risk management saves. So ask, what is the actual rule for how much you risk per trade? Not vibes, not use your judgment. A rule. What's the maximum daily loss? What's the weekly stop? What's the plan for a string of losses? What happens when volatility doubles? What happens when your system stops working for a month? What happens when you're wrong 5 times in a row? If the course doesn't teach survival first, it's not training you to operate. It's training you to gamble with better-looking charts, and survival is not optional. The first job of investing, of any financial operation, is not to make money. It's to avoid getting knocked out of the game. That's pure Graham. Preservation of capital, safety of principle, margin of safety. Question 5. Do they benchmark honestly against a defensive alternative? This is a big one, and it's rarely discussed because it's devastating to sales pages. A serious program should be willing to compare its results after costs and taxes against a boring, low-fee, diversified portfolio that a defensive investor could actually hold, something like broad index exposure, a bond allocation, cash reserves, regular contributions, and disciplined rebalancing. Not because passive is perfect, but because it's the realistic competitor. If a day trading method can't beat a simple, low-cost, long-term approach on a risk-adjusted basis over time, then the course is selling you complexity for entertainment. And entertainment is fine if you label it as entertainment, but don't call it a retirement plan. Question 6. Are incentives aligned, or are you the business model? This is the question that makes people uncomfortable, but it's the question grown-ups ask. How does the instructor make most of their money? If the real money is in subscriptions, upsells, affiliate links to brokers, prop firm partnerships, recurring signals, paid discords, VIP rooms, or endless funnel ladders, then their incentive is not primarily to make you a great trader. Their incentive is to keep you engaged. Engaged people renew. Engaged people chase. Engaged people blame themselves, not the system. Again, not automatically evil, but incentives shape outcomes. And Graham would demand you see the structure clearly. Now, breathe. Because if you've been watching this with that checkout page in the back of your mind, you might be thinking, so what? I should never learn? I should never try? No, that's not what I'm saying. What I'm saying is, treat this like Graham would treat any financial decision. Separate price from value, separate story from evidence, separate excitement from safety. If you still want to learn trading after this test, there are ways to do it that don't sabotage your financial life. You can cap the tuition. You can decide in advance, this is education money, not retirement money. You can paper trade first. You can start with tiny size. You can refuse leverage. You can set loss limits that protect your capital and your mind. But you cannot do what the internet quietly pushes you to do. You cannot confuse a high stimulation activity with a wealth building plan. Because wealth, the kind that protects your family, your future, your dignity in retirement, comes from compounding time, discipline, and avoiding fatal mistakes. Fatal mistakes are rarely dramatic. They're usually fashionable. They usually arrive in the form of a trend that feels like a shortcut. Meme stocks, cryptomanias, guaranteed signals, funded account challenges with hidden rules, AI bots that supposedly print money, option scalping marketed like a cheat code, a charismatic person telling you the market can be mastered if you buy the right course. Graham watched eras of this come and go, different costumes, same human wiring. That's why he gave us Mr. Market, not as a cute metaphor, but as a warning about mood-driven decisions. The market is not your teacher. The market is not your therapist. The market is not your paycheck. The market is a place to allocate capital when the odds are acceptable. And that brings us to the alternative, the boring edge that doesn't go viral, but quietly works. If you're a normal American investor, job, family, bills, real life, your biggest wealth lever isn't finding a secret pattern on a 5-minute chart. Your biggest wealth lever is designing a system you can actually follow through noise. A defensive investor blueprint, Graham style, looks like this. You set an allocation you can live with. Graham famously suggested keeping stocks within a broad range, neither too low nor too high. Because the point is not to be a hero. The point is to be durable. In modern terms, diversify, keep costs low, and choose a stock, bond, and cash mix that matches your ability to stay calm when the market gets ugly. You maintain a cash buffer, an emergency fund, so that a job loss or a surprise expense doesn't force you to sell investments at the worst moment. That's margin of safety in real life, not just on paper. You contribute consistently. You automate. You don't negotiate with yourself every month. You rebalance. Not because rebalancing is magical, but because it's disciplined. It forces you to trim what got expensive and add to what got cheap. Exactly the opposite of what emotions want. You respect fees. A small fee seems harmless in a single year. Over decades, it's a tax on your future. Graham would call that a permanent headwind, one you don't need. You don't try to predict. You try to prepare. And most importantly, you avoid the one thing that kills more middle-class retirement dreams more than any bear market: behavior, panic selling, chasing hype, overconfidence, the need to do something because the news is loud. The impulse to turn investing into a slot machine because boredom feels like missing out. Graham didn't promise you excitement. He promised you a framework to keep you from doing dumb things at the worst possible time. And if you're starting late or starting small, that framework matters even more. Because when you don't have unlimited time, you can't afford catastrophic detours. You can't afford a blown account, a tax mess, a confidence crash that makes you abandon investing entirely. Your goal isn't to win the internet. Your goal is to fund your life. Now let's close the loop. I want you to imagine that checkout page again, the countdown timer, the limited seats, the testimonials, the luxury car B-roll, the comments saying, "This changed my life." Here's what I want you to do. Right now, before you buy anything, scroll the page and try to answer these 6 questions. Honestly, do they show a verifiable, long enough track? Record after fees, slippage, and taxes? Do they show real drawdowns and losing periods, not just wins? Can they explain the edge clearly, without mysticism, and with a believable mechanism? Do they teach position sizing and survival rules in a way that prevents ruin? Do they benchmark against a simple defensive alternative, honestly, after costs? And do their incentives align with your success or with your ongoing payments? If you can't answer those, your decision is already made. The course is asking you to trust the story instead of the evidence. And in Graham's universe, that's speculation. Now, if you can answer them, and the answers are solid, then you're still not done. Because the final filter is you. Are you buying this because it fits your long-term plan, or because you're trying to buy relief? Because markets are very good at selling relief. They sell it at the top. They sell it before the crash. They sell it when you're tired, when you feel behind, When your timeline feels tight, Mr. Market doesn't care about your feelings, and the algorithm doesn't care either. But you can. You can choose a path that's not flashy, but is resilient. You can choose a plan that can survive a bad year, a stressful month, a personal emergency, a market crash, and still keep moving. That's the difference between someone who tries things and someone who builds wealth. So here's the simplest Graham-style rule I can leave you with. If you cannot clearly see the downside and survive it, then you do not have a margin of safety. And if you don't have a margin of safety, you don't have an investment. You have a bet. Close the tab if you need to. Save the money. Build your buffer. Keep your fees low. Allocate intelligently. Rebalance. Let compounding do what it does best. Work quietly while everyone else chases noise. And if you still want to learn trading after you've protected your foundation, do it like a professional would. Small size, strict limits, and never with money your future depends on. Because the smartest investors aren't the ones who found the fastest way to get rich. They're the ones who found the most reliable way not to get broke. That's Benjamin Graham investing.